Hello there everyone, today's video we're going to have a look at an HMRC spotlight. Now what is a spotlight? It is an area of the tax planning world that HMRC don't think works basically. So let's look at this. So in the tax planning world you have all sorts of different ideas across all sorts of taxes, some of which are actually thought of by HMRC themselves from a tax planning point of view. Like, for example, you get tax relief for this and that, and it's HMRC that specifically say it's all there in black and white. If you do this, so much will come off your tax bill. No ambiguity at all. Other types of tax planning, a little bit more of a grey area. Clever tax advisors come up with ways that they think they've spotted holes in the legislation that are going to save lots of tax for the taxpayers. And in their opinion, that's genuine tax planning that works. Now, often what happens is HMRC cotton onto this and they go, aha, we don't think that does work. We think you've got it wrong, Mr. Tax Advisor. And what also tends to happen is when someone comes up with some of these schemes and they think there is broad appeal, they will sell that tax planning to many taxpayers and basically a marketed tax planning scheme. Now, when HMRC cotton onto these and they don't like them, they think, look, do yourself a favour, Mr. Taxpayer. Don't be paying these guys over here big bucks because this thing doesn't work or we don't think it works. And they issue what they call a spotlight on that particular scheme, that tax planning arrangement, as to why they think it doesn't work. So you've got to be wary of these things. Now, of course, we've also got to caveat that and say just because HMRC say it doesn't work doesn't mean it doesn't work, because ultimately it's the courts, it's the law that will decide this. HMRC interpret the law. They don't write the law. Tax advisors likewise interpret the law. It's the courts, it's Parliament, it's the government who come up with the rules in the first place. HMRC are tasked with policing the rules. Tax advisors are tasked with advising clients what on earth all the rules mean when you've got a stack of legislation this high. But anyway, so this spotlight, what I'm going to say to you, doesn't necessarily mean categorically that it doesn't work, although I would actually suggest in this case it probably does. But the spotlights are HMRC saying we don't think it works. But ultimately, like I said, that point, whether it works or not, would be tested in a court of law. So let's get straight in and have a look. Now, this is all about property, particularly property incorporation of a residential portfolio. So since the rules have tightened up on landlords several years ago in things like extra stamp duty, interest relief restriction on the interest element of buy-to-let mortgages, people who have property portfolios, landlords, have looked at ways to basically reduce their tax burden, this increased tax burden. And one of the things that they've looked at is property incorporation. Now, I've done separate videos on this, and I'm just going to briefly talk through the planning that is out there. This is not what the spotlight is on, the first part of what I'm going to tell you. So this is what many hundreds, probably thousands of landlords have done. Husband and wife, they own a load of properties and they then transfer them to a partnership. So they set up in a formalized partnership arrangement, move all the properties across. That is a non-event for capital gains tax because a partnership is what we call a transparent entity. So in effect, they are transferring assets from themselves to themselves. So no capital gains tax. They run it as a partnership, and then after a few years, they incorporate. What does that mean? It means they transfer the properties from the partnership into a new limited company of which the same individuals are now shareholders. Those who were partners are now shareholders. And basically the rules say that because these shareholders are the same individuals who were partners in the partnership, there's no SDLT, because those are the two big taxes when you essentially incorporate a property business: stamp duty, land tax, and capital gains tax. But if you do it in this way, you don't pay capital gains tax and you don't pay stamp duty, land tax. Okay. And you can do, I've done whole separate videos on it as to why that is, but that's basically the way that it works. So there are some tax advisors out there who have, instead of advising on this, have come up with this, which I'm about to go through. And this second one is the one that HMRC has got its current spotlight on to say, I don't think this works. So what is it? Well, it starts off exactly the same. Husband and wife, property portfolio, individual buy-to-lets that they own jointly. So we'll just do a little bit of compare and contrast. Compared to the first arrangement, same starting point, transfer all the properties into a partnership. Okay? Remember, no capital gains tax on that because you are selling from yourself to yourself, CGT free. But this is where the similarity ends. So the next bit in the planning, which has the spotlight on it, is this use of a limited company. So rather than say, well, after a few years, we're then going to transfer the properties from this partnership into a limited company, what this scheme of arrangement purports to say is, look, listen, we know that companies are good. Companies are good from a tax planning point of view. You generally pay less tax. That's the whole point of incorporating a portfolio in the first place, because of the restrictions that are, given to these individual landlords. Do it all through a company, less tax burden. Fine. So, some bright spark had the idea of saying, well, look, we know that companies are good, but rather than go from selling assets, transferring assets from a partnership to a company, why don't you just leave them in this partnership, but instead we'll have a limited company and it will be what we call a corporate member. So, in other words, where here we had three distinct entities: individuals, partnership, company. Here we've got two: individuals, partnership, and the company is a member of the partnership. So the company essentially owns this partnership together with the individuals. So you've got what we call a mixed partnership here. And the tax planners who come up with this say, look, you're kind of getting the same benefits as if you'd have done this, because in this limited company, you can allocate profits from the partnership into the company, pay lower rate of tax, and just leave enough profits in the partnership to be allocated to the individuals to keep them in the basic rate of tax, so that they're not going over the, into the 40% tax, they're paying tax at 20%. Because partnerships, you can manipulate the profits legitimately, how they are allocated to the various partners. However, all well and good, but there is a rule. It's called the mixed partnership rule. Now, forget property for a moment. Just any type of business. This arrangement here, partnership with a corporate member, was all the rage about 15, 20 years ago. So many businesses did it. Professional services firms, widget makers, you name it, lots of different organizations set themselves up like that. And it worked fine. You could allocate profits, like I said, how you wanted. So you'd move profits to the owner that was a limited company, make use of the lower rates of tax afforded to companies. But HMRC put the brakes on that, and around about 2014, 2015, and they said, look, we don't like these mixed use partnerships. We have a corporate member, one of the owners, one of the partners is a limited company. We don't like the fact that you can shelter a load of profits and pay lower rates over here. So they changed the rules, and they said basically that you could only move enough profit into this limited company commensurate with the contribution that the corporate member made to the partner. Basically, they said you can't move a shed load of profit into the corporate member. So that's been around now for best part of a decade, and a lot of businesses that was partnerships that were structured in this way with corporate members just basically decoupled the corporate member, well, because it didn't work anymore. So I'm actually quite surprised to hear that there's a lot of people going on about sort of resurrecting this planning, particularly for landlords, because the principles apply the same way in terms of whatever HMRC didn't like about it all those years ago would still apply, regardless of the fact that it's a property partnership as opposed to a firm of solicitors or whatever type of partnership it is. So, comes as no great surprise to me as a tax advisor, knowing about the history of all this stuff, that HMRC have got a spotlight on this type of arrangement because of the mixed partnership rules that have been in for years now. So, if you are a landlord and some tax advisor has said, hang on a minute, let's do this, be very, very careful, because HMRC will crawl all over it. They have issued a spotlight and they basically say this doesn't work. We're not saying that the top one doesn't work. This has been going for a few years now, but remember, the corporate, the company in here is totally different to the company here. In here, you are selling assets from a partnership to a company. In here, the company is a part owner of the partnership. Completely different, even though you may say, well, hang on, individual partnership company, down here, individual partnership company. But like I've explained, hopefully, the last 10 minutes, it operates completely differently with this company. And this is the one that HMRC say doesn't work. So be wary if someone has spoken to you and said, hang on a minute, let's do this, because there is that spotlight on it, and you will get looked at by the taxman. So just an overview there on the latest spotlight from HMRC, particularly focusing on property portfolios and tax planning thereon. If you like this video, please do subscribe, and as always, I will see you soon.